Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Phil Mackintosh, chief economist at Nasdaq. We're going to take a look at the data that the Fed is focused on as it determines its strategy. And Phil, you guys wrote in your note last week, there's an adage that the Fed rate hikes are going to continue until something breaks. And the fireworks went off this week for sure.
Something might have just broken.
Yes.
Yeah, so obviously you're referring to all the bank crises that have sort of filtered through initially America and then the world over the last couple of nights. So there's a few banks that have been under pressure. And it kind of makes sense when you think about a lot of the mortgages people refinanced or locked in for a long time at about 3.6%, back when interest rates that you paid on deposits as a bank were basically zero. Now that the Fed's got rates up closer to 5, it's like suddenly that's not profitable anymore, and so the banks have to manage their interest rate risk.
So the market's really gone from worrying about rate hikes to, oh, potentially we won't do anything, and some are even thinking cuts.
Exactly. I mean, that was the one really interesting thing that we saw with all that really strong January data was the market had been pricing in a 5% peak in rates, and then suddenly we looked like we were having really strong inflation, really strong spending. The market started pricing in a 5.5, maybe even 5.75 peak, and the Fed's been talking like that for months as well. All of a sudden this week, the market's completely changed its tune. It's looking at maybe having no hike this week and sort of maybe no hikes going forward.
Right, and if we look at that chart with the March rate hike odds, I mean, just like we saw the velocity of rates moving up, the expectations have certainly moved inverse to that.
Yeah, I mean, it's given the Fed something to think about. If the high rates are really causing strains on the financial system, that could affect confidence, and maybe that alone will start to bring down inflation, and the inflation itself might not be the thing that needs to be tackled anymore.
So are the CPI data still concerning for the Fed?
So that was the other data point that came out this week. It kind of got overwhelmingly or overlooked. It came down to 6%, so it's kind of on a trajectory of coming down about 0.5% per month, which is pretty good, but it's still obviously higher than the sub 5% that we're charging on interest rates here. So we still have a negative real interest rate, and 6% is relatively high, and we've seen the components kind of changing. So housing is like replacing all of the energy and the goods inflation that COVID caused. And it's just making it harder for inflation to come down as quick as a lot of the models think it's going to.
So let's take a look at some of those individual components that comprise CPI, starting with energy. I mean, that's been a big part of the story as well.
Yeah, and when you think about, we just had the anniversary of the Ukraine invasion, and when that happened, we realized we had potentially shortages of natural gas in Europe, which pushed up the gas prices there. They started importing US natural gas, which pushed up the prices here, so our heating costs went up. Oil costs went up around the world because Russia was a big producer of oil that's turned into gasoline. That was 12 months ago. So now we're back sort of $70 odd on oil. Natural gas in Europe is back to pre-COVID prices because they've replaced a lot of what they needed to and started using less gas. So that component of inflation could actually turn deflationary, and it has been a few months recently.
Well, speaking of prices, we got to talk about home prices and rents. They're still kind of elevated.
Yeah, so inflation's a bit weird because even though we all know our houses are probably falling in valuation, the component that's housing is mostly about rent. And so it's only when rents start to fall that you really see the inflation for the housing come down. There is good news though. A lot of the forward indicators do seem to show the rents have stopped climbing and are maybe starting to come down now too. So that'll help.
What about hourly wages?
Another one that's relatively good. I mean, it's not going to be deflationary, which is probably good for all of us with our jobs. It had been rising really quickly. Some segments of the economy that were under a lot of stress as we pivoted from the goods part of COVID spending into the services part of COVID spending. Leisure and hospitality wages were going up 12-15% per annum. That's all come back down. It's around about 3% now, which you could argue is about right with productivity gains to support that 2% inflation target the Fed wants.
All right. Certainly a lot of data to consider for the Fed next week, that's for sure. Phil, appreciate the insight. Thanks for joining us. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.